Good afternoon and welcome to the faculty panel discussion on the current financial crisis. I'm Mike Lawson. I'm the school's Senior Associate Dean, and I'll act as the moderator for our discussion. If I could ask you each to please turn off your cell phones, not just put them on vibrate, but turn them off because they interrupt the audio transmission of what we're doing, so I'd greatly appreciate that. And I do also understand that this is New Year's and some of you may need to leave to go home for celebrations. Happy New Year to our friends who are going to be doing that. And if you could just leave as quietly as possible, that would be appreciated. This crisis has brought us new financial terminology such as credit, debt swaps, and mortgage-backed securities. We've gone from a housing bust to an explosion with real financial consequences for millions of Americans. The crisis has spilled over from the financial sector to every corner of the economy here in the United States and abroad, creating a credit freeze that threatens the very functioning of our very credit-dependent U.S. society. And the phenomenon of credit and housing are related. Credit spending was enabled by the housing market's rapid escalation in value. With the list of failed or failing financial institutions, Bear Stearns, Lehman Brothers, Freddie and Fannie, Washington Mutual, Wachovia, Morgan Stanley, growing daily, our political leadership crafted a draft of the Emergency Economic Stabilization Act of 2008. But just a short time ago, the U.S. House of Representatives voted 207 to 227 to reject the act. So far, the markets have reacted with something short of stability, down over 600 points. This is no longer a Wall Street or a Main Street story, but instead will be the economic event that will likely define your generation. Each of us, and especially business school students, has an obligation to understand the causes, the political and economic remedies, and how we can chart a positive course for the future. I am delighted to be with 4 members of the faculty today who will serve on our panel. To my immediate left, Mark Williams, Executive in Residence in the Finance Department. To his left, Nalin Kulatilaka, the Wingtat Lee Family Professor in Management in the Finance and Economics Department. To his left, Marcia Cornett, Visiting Professor of Finance. And to her left, Don Smith, Professor of Finance in our Finance and Economics Department. I have a few questions that I would like to ask each of our panelists, and I would like them to respond with their own unique perspectives. After hearing from each of the panelists on these questions, we will then entertain questions from you. You'll note that where there used to be an aisle, there is a microphone, and so when we get ready to take questions, if I could ask you to come to the microphone. I should also add that we are taping this event and that it will be available on the school's website. So, the first question, what are the root causes of this crisis? Simple enough question. Who would like to start?
I'll go ahead and start.
Please.
The basic problem and the foundations of what's going on today really started back in the late 1990s and the early 2000s. Because during that period, interest rates were at an all-time low. The economy was not doing great, but the housing market was booming. It's a big financial purchase that a family makes when they buy a home. Interest rates were very low. Not a lot of other places to put your money. People would buy a home. People that had purchased homes, interest rates very, very low, historic lows, they decided, well, maybe it's a good time to refinance my mortgage. Mortgage, basically, for those of you not familiar with that, you're going to purchase a home, don't have the cash up front to buy the home, you'll go to a commercial bank, you'll go to a mortgage bank, they'll lend you the money to do that, and generally on a 15 or 30-year mortgage. Well, what happened in the early 2000s, again, the mortgage market built up to over an $18 trillion market. Became very, very competitive. People kept coming in for loans. Banks, mortgage bankers wanted to grow. got to a point where some of the people started coming in for loans really weren't qualified to get the loan that they've applied for. Mortgage bankers in particular, commercial banks we'll talk about a little later, very heavily regulated in terms of who they're allowed to lend to. Mortgage bankers in particular started to give out loans to the higher risk part of the group in the economy. Because they were high risk and interest rates were so low, these mortgages were issued at what is called a variable rate mortgage. Variable rate meaning that the interest rate on the loan can increase over the life of the mortgage. So borrower comes in 2003, they get a mortgage and they're paying maybe 4.5% on that mortgage. Well, in the mid-2000s, 2005, 2006, interest rates started increasing. Well, again, a variable rate mortgage, as market rates increase, so will the rate on your mortgage, meaning your payments start increasing. Again, and I believe we'll talk more about this later. When those loans were issued, a lot of the mortgage bankers, some of the bankers knew that if interest rates rose too high, those people wouldn't be able to pay their required mortgage payments. Well, interest rates did rise, and in 2006, 2007, and 2008, we now have a lot of loans, not a huge section, certainly not even a majority of the loans out there have problem, but we have a significant chunk of the mortgages out there where the variable interest rate has risen to a point that the homeowner just can't make their payments on the mortgage. And as a result, we are seeing just records and records and records of numbers of foreclosures. They've had to walk away. Now, in addition to that, one of the big problems has been that in the last 20 years, mortgages have been securitized. And I think, Don, would you like to talk about that?
Yes. First, let me say my unique perspective in this is having spent 25 years here teaching about how the American mortgage-backed securities market is a success story and the value of so much of this. And so I guess I feel a little defensive about it, but the market has changed. So the first point I want you to understand is that the traditional mortgage, the long-term, fixed-rate, fully amortizing, level payment mortgage, your parents' mortgage, your grandparents' mortgage, is a very safe asset. At least it was traditionally, for several reasons. First, it was often government guaranteed. There were government agencies, the FHA and the VA, insured many of these mortgages. If they weren't insured, then they were very conservative in that the amount of the loan would be only about 80% of the value of the house. And if the homeowner didn't have quite that conservative ratio, they would have to go out and get their own private mortgage insurance. So the traditional loan by itself was very safe. Another reason why it was safe, the monthly payment was fixed in nominal terms. And over time, these were long-term, by the way, these were 30-year mortgages. Over time, as the monthly income would rise, the share of income that was needed to pay the mortgage would fall. So it was declining credit risk over the lifetime of the mortgage. So it was very safe from the originator's perspective. And we had institutions, savings and loan institutions, mortgage savings banks, some commercial banks that did nothing but originate and hold these mortgages. But that created another problem, interest rate risk and liquidity risk, because these mortgages were themselves not very liquid assets. And there was interest rate risk because the banks were financed with short-term deposits, but yet were holding long-term fixed-rate mortgages. So we had this success story, and that's how I'd at least originally describe it. We created institutions, Fannie Mae and Freddie Mac, the agencies, that were in the business of buying mortgages from the originating banks, therefore making them liquid instruments. We also had another agency near Ginnie Mae. You don't hear quite as much about Ginnie nowadays. Ginnie Mae is still part of government, but Ginnie Mae was created to create a securitized product. So securitization, a key word for us today. So to securitize is to turn a loan contract into a security, a marketable security. And the design of this secondary market is to get mortgages from where they're originated in the banks to those who ultimately should be holding them. That's the problem. The banks are not structured to hold a long-term mortgage. Again, their source of funds is short-term deposits. So who should be getting them? Who should be investing in them? pension plans, insurance companies, mutual funds that you individuals would hold in their defined benefit contribution plan, defined benefit or defined contribution pension plans. So the system is intended to take mortgages from where they're originated to the ultimate investor. And it was very successful for many years when the underlying asset was safe. They dealt with the problem of credit risk. They dealt with the problem of credit risk by the underlying mortgage itself being safe. But we had interest rate risk. So what happened? Well, the underlying asset changed. We got the development of the subprime mortgage market, which grew starting in the 1990s and is now, well, in the last few years, a significant component of the mortgages that were being originated. These were very different. Many of the investors in these mortgages didn't have a track record of the defaults that could be experienced on these mortgages when the housing prices started to fall. So they were known to do well when housing prices rise because really regardless of how your mortgage is structured, if the value of the house goes up, you can always refinance if you can't make your payment. But we didn't have a track record of the lower housing price. So we didn't have good data. We'll go on more and more about the problems. But again, let me just stop here. Traditionally, we had a very safe asset class. We now realize it's a very high yield, almost a junk bond, basically a junk bond crisis.
I can add one thing to that, which is, from my perspective, which is to look at how these kinds of securities get valued and priced. And as Don was alluding to, the focus in the past used to be not on the default of the mortgages, but rather on other types of risk, like interest rates falling or rising, and people moving and having other kinds of reasons that might make them to prepay the mortgage. So for example, the Fannie Mae and Freddie Mac models that were used to value these securities primarily looked at the history of when people prepaid mortgages. And the focus was really on that side of the story, but not on default. And as a result, the models that people used did not immediately capture the underlying sources of risk that were newly introduced into the market. So there's a breakdown of valuation models that also could have contributed to this.
Good. And there's two other trends I think are extremely important. I think Don did a nice job talking about securitization in particular. But what we see as the trend in banking became into securitization, and that's the idea of bundling millions and billions of dollars worth of underlying securities, taking them, throwing them on Wall Street, and then getting fees back. That created a money machine for money center banks, very large banks, commercial banks, as well as investment banks such as Lehman Brothers. And what you saw as this accountability question, that is, as these securitizations happened, there was a less of a sense of the old traditional type of banking. That is that I would know who I gave my mortgage loan to, and I would actually see them in the community, and I would actually make sure if they lost their job, I'd give them a call and ask them, how are things going? Can you make your payment? But that connection, that is, with the customer was severed as soon as securitization started. And that was a very big trend, which has actually changed so to the point where we had basically investors in Finland and Iceland that had exposure to subprime mortgages located in Texas. So you have to ask yourself, you know, what sort of disconnect was there between the risk taken and who was taking the risk? So that's one very important trend. The other important trend in banking, which has changed dramatically, which is actually, which I consider to cause the subprime debacle, was the drive by not only financial institutions, but also very large independent investment banks to go for what we call fees, fees, and fees. Very much the banking model has changed dramatically. It used to be even 20 years ago, and Marcia would talk to this later on, but banks used to make lots of money by making loans. They would get interest income. They would actually make money in regard to doing services, investment management. But finally, this drive for fees, that is for taking products and actually redeveloping them and throwing them in the financial market and securitization, has really been a driver for banks. I mean, as customers, we all see it. How many of you are Bank of America customers? So how many of you understand what fees are about? So in essence, that is the underlying drive of banks. And as banks continue to drive towards more and more fees, and I think what's happened in the financial market is a very big wake-up call. banks are going to reconsider their risk and return profile, in particular seeking fees at the cost of the level of risk they took.
Can I just add one thing, Mike?
Of course.
Which is, as Mark was describing, that it's very clear that the people who were investing in these mortgages no longer were the local banks who knew who their borrower was. So the people who bridged this gap were agencies that rated the securities, the Standard & Poor's and Moody's and other rating agencies. So as an investor, instead of knowing who actually borrowed and their risk characteristics of default, we began to rely more on these independent intermediaries who began rating these things. But one of the problems that we found was that the incentives for the rating agencies weren't necessarily to be revealing of what the underlying sources of risk were, because they also relied on fees that depended on how many mortgages were sold and so on. So that becomes an important part of this.
Yeah, that's great. That's a great point.
That's a great point. Thank you very much, all of you. Well, I think that's a good start. Well, as we keep walking through these questions, I think it gets murkier and murkier, right? So I guess the next question that I have is, let's talk a little bit more about recent events, the collapse of so many institutions. Why? Why the collapse? And why so many?
Okay, I'll take that one on real quick. For most of my students here, I see a number of them, they're probably surprised by two things. Number one, I'm sitting down, right? And number two, that, you know, I was quiet for a moment. Okay, so let's focus on that. What's happened recently is a unique and historical phenomenon, and it's something we're going to remember forever. You look at the stock market today, we had a drop of almost 700 points, the largest drop in history. So what's causing all of this? Well, clearly what happened was the underlying risk profile of banks changed fundamentally. That's corporate banks as well as independent investment banks. When I started teaching last fall, we had 5 independent investment banks. If you look at Morgan Stanley and Goldman Sachs, what's left at the heap and their commercial banking powers they just received last Sunday, we have no independent investment banks left. So this is a phenomenal groundswell within a shift within Wall Street. So what does this all mean? Well, commercial banks failed because they increased their risk profile. That is, they took greater risks, they overdosed on risk, subprime risk, more so than what they could be compensated for. And it's as simple as that. That is, if you take on risk in business, you have to be compensated for the level of risk. So clearly these banks either, number one, did not understand the level of risk they were entering into, or two, they understood it, but they ignored it in the pursuit of making billions of dollars. In particular, what I'm really saying is that banks were willing to risk billions of dollars to make billions of dollars. And in that equation is a very interesting thought. If there's an incentive system on Wall Street that's set up or for banks to actually risk shareholder value in the pursuit of personal benefit for executives, then there becomes an underlying problem. And the fundamental balance between risk and return is severed. And that's clearly what happened on Wall Street. That is, that risk was assumed or taken either because it was clearly not understood, or it was, and it was just ignored in the pursuit of gaining profitability.
We want to just maybe talk about the two types of risk that Mark talked about. There's been failures of the investment banks, there's been failures of the insurance companies, and then there's been failures of some of the biggest commercial banks. Kind of two big things that have happened. One, we've had that huge increase in the default on the mortgages themselves. So those banks that are holding those subprime mortgages are losing there. We're having, again, record numbers of defaults, so your mortgages on the books are not being paid. And that's particularly hurting the commercial banks. And then secondly, those mortgages, as Don mentioned, are the basis for all of these collateralized mortgage obligations or mortgage-backed securities. And as people aren't paying and defaulting on their mortgages, not only are the mortgages on the bank's books bad, but all of these defaulted mortgage-backed securities are decreasing in value. And it was really the mortgage-backed securities that resulted in Bear Stearns, which was the first big investment bank to fall in March. They actually had 2 hedge funds that were almost fully invested in these mortgage-backed securities. once the two hedge funds failed, once the clients of Bear saw that, they started pulling their money out, and there goes Bear Stearns. Secondly, Fannie Mae and Freddie Mac are backing all of these mortgages, and they are trading all these mortgage-backed securities. Well, as they both start failing, there goes Freddie Mac and Fannie Mae. And then we start getting the Lehman Brothers that have all the mortgage-backed securities, the Washington Mutuals that actually had the mortgages out there. So it's the collapse of the mortgage market, and particularly the subprime mortgage market, and then the mortgage-backed security market that's causing the investment banks, the commercial banks, and now even we've seen insurance companies fail as a result.
Then you get AIG gets into that equation.
Right.
As
Yeah,
the
who was also
insurer.
holding the mortgage-backed securities.
Yeah, right.
We can talk so much about all of these topics. Let me just hit on a couple of them. Let's just focus first just on investment banks. Why do we no longer have an investment banking industry, which is phenomenal when you think about it, how so many of you were thinking about careers in an industry that no longer exists. There are a couple of changes we can focus on. One is a change in the basic business model of an investment bank, and as Marcia was saying, using their balance sheet. Now, we know what investment banking traditionally is. It's advising clients on mergers and acquisitions. It's helping with the underwriting of new securities. But there was a time in the last 10 years that the big investment banks started to take on and hold significant assets. Loans, bridge loans as part of the M&A activity, the structuring of these collateralized debt obligations. Maybe we can try to walk through that in a little bit. But they would be in the market of selling them, and for a while having them on their books. And to finance these assets, they would issue debt, primarily short-term debt. And when they were not able to roll over that short-term debt, they ran into a significant liquidity crisis. So it's really the fault of the business model. And we can go back, hopefully we'll talk about executive compensation. And my complaint about that is a system whereby we were paying senior executives and others huge salaries based on one slice of a long-term business plan. You see, if you take a business plan that relies on short-term interest rates being low and there being liquidity in the market, you will do very well when the market's stable and interest rates are low. It works very well, and you have some very good years. And if you were to look at the salaries pulled down by some of these people, we're in the millions, hundreds of millions. Well, I would think that the compensation really ought to be based on a longer time cycle, because you are inherently running the risk that short-term rates rise or markets become illiquid, and then there will be some losses. So the compensation really ought to be based on the profitability over a longer time frame, and year-by-year profitability is just the totally wrong time metric for thinking about executive compensation. One other thing, and then I'll give up the mic. Another thing that we saw the investment banks doing, and some commercial banks as well, is really avoiding the regulatory process by setting up shadow banks. You'll hear the term conduit or SIV, structured investment vehicles, being set up. Essentially, these were off-the-books banks that were not regulated. They were not being captured in the regulatory capital the banks would have to hold. But they looked just like banks. They were holding assets that involved credit risk. They were financing themselves in short-term markets bearing the same interest rate and liquidity risks as any other bank, but they were hidden. And we were shocked, I was shocked, to find out how large some of these had been. And then when Citibank had to bring them back onto their balance sheet, we realized they really were part of the bank, because when they started to fail, they had to reabsorb them onto their balance sheet.
Where investment banks may not exist, but there are some new opportunities that might be rising. And I think this has to do with the question I would pose is, why was this realized so suddenly? Why didn't people see this all along the way? And I think the response to that might have something to do with how the assets that we were talking about, the securitized mortgages, how they are reflected on a firm's balance sheet. If they are in fact reflected as the true market values, then we would have seen their value erode over time, and it wouldn't have been a shock to us. But one of the things that has been a problem is that the marking to market so reflecting the true value of the assets in the balance sheet, was often broken, both because of the way the reporting standards are and because it was actually quite difficult to do the valuations of these underlying securities. So as we get to the remedies, we'll talk more about this, but an important missing link that made all of these institutions, the Bear Stearns to the AIGs, not realize how bad they were in all along the way, how the investors didn't realize it along the way, was because their assets were not marked to market.
I didn't really have this as a question, but as I've listened to you all talk about the sort of the risk-return breakage that seems to have pervaded the system in a particular way, and then the off-the-books banks that Don talked about and the like, isn't there regulation that's supposed to be looking after the way these firms behave? And did they also fail us at this time?
Yeah, and I think that's a great question. I mean,
thank you.
Yeah, unfortunately, we're sitting here Monday morning, right? The football game already happened. We know the results. But clearly what we can say on the regulatory front is the SEC was asleep. And we can actually say the Fed itself could have done more. So let's first talk about the Securities Exchange Commission. In particular, this organization was there to regulate broker-dealers. In particular, they had roughly 146 broker-dealers last year that they were to regulate. What we know so far is of those 146 broker-dealers, such as Lehman Brothers and Bear Stearns, they actually committed and finished reports on only 6 of these broker-dealers. So can you imagine having the scope of what you're supposed to supervise and only doing a full examination and report complete on only 6? And only after Bear Stearns was taken over by J.P. Morgan was that report completed. And I think that, to me, sort of encapsulates how weak the regulatory environment is. I mean, we all know in regard to sports how important referees are. When we look at a professional basketball game, we know the importance of the referees on the sidelines, not because the professionals on both teams don't know the rules, but we know that how important it is that these rules themselves are followed, and that if they're broken, that there's ramifications. And clearly, if you look at Wall Street and you look at these organizations, these financial institutions, there were clearly rules, but the rules themselves were not strictly enforced, and we can actually talk later on about why that was. But clearly, Christopher Cox in particular, the SEC, has taken it on the chin. In March, when basically the Federal Reserve had to open up its discount window and allow other financial institutions, in particular, to allow Lehman Brothers, Morgan Stanley, and Goldman Sachs to go into the credit facility, that was a very important sign to the market. And what it said was the SEC failed its job, the Fed was going to take over. And that's really where we are now. The Federal Reserve is going to have greater responsibility as it relates now to the fact that Morgan Stanley, Goldman Sachs, the 2 largest independent investment banks. Now, the big question, I think, for all of us should be, is the Federal Reserve up to the challenge? And currently, what I know about the Federal Reserve, I used to be an examiner for the Federal Reserve. I know they have bright individuals, but I also know that they're understaffed. I know that there's not currently an incentive system to sort of cultivate and keep bright examiners there. And I think that is the weakness that we're going to see. Unfortunately, the bailout, or as we call it, the economic stability bill, was not passed by the House today. But eventually, there will be a compromise reached and passed. And part of that compromise is going to have to weave in the big hole that we need to plug, and that is the weak regulatory oversight. It's clearly missing. We've experienced the financial loss, so now it's time to fix and plug that hole. And that's the SEC and the Federal Reserve, and focusing on their mandate.
Not only is the lack of oversight of the SEC and has been a problem through all this, there's also a problem in that there are multiple regulators out there watching different sectors of the industry. The SEC regulates and is supposed to be monitoring the investment banks, but then the Federal Reserve and the FDIC are supposed to be monitoring the commercial banks. Well, then you look at a bank like, and you think it's a bank like a Citigroup, but within Citigroup, there's the commercial bank, Citibank. There's Solomon Smith, and they're regulated by the Fed and the FDIC. Then there's Solomon Smith Barney, who's regulated by the SEC, and then they have insurance companies in there. And so one of the big problems is you have all these different regulators trying to oversee different segments in the industry. I also think what will end up happening is you're going to see a consolidation. And I think Mark alluded to it, very likely the Fed will now be the overseer of all financial institutions and plug up some of the holes that we certainly have had and have caused a lot.
Don?
One way of thinking about we always think of the central bank as being a lender of last resort, and now in the future we'll see central banks will be a market makers of last resort. And that's part of what they'll be doing with the collateralized mortgage obligations. Just a couple of other points, though, on the regulation. Let me speak for one of my colleagues who I'm sure would love to be here, Professor Zvi Bodie from Bodie Kane Marcus, you'll know. One of the things he's advocated for many years is an approach to regulation which would focus on function rather than institutions. And traditionally, we've had institution-based regulators. So a separate regulator for insurance companies, a separate one for commercial banks. What we really have to realize is that an AIG is an insurance company, but it's doing a lot more than that, and is very active in the derivatives market as well. So we have to think of what the functions are and then change regulation. That's going to be key, as well as mentioned earlier, we have to regulate the rating agencies.
Can I, just a little bit of a follow-up, not so much on the regulatory one, but on the nature of the collapse. But can you shed some light on, I mean, Bear Stearns was a while ago, and I can remember reading in The Economist and other magazines about issues around this whole market over a year ago. So why has it just bubbled along like this and then all of a sudden just become a crisis, you know, the last couple of weeks? Is that a good question, Mark?
Good question.
Well, yeah.
Well, I think the reason why it's bubbled over, and I'll be very brief here, is a lack of confidence, and that is we know the capital markets function very efficiently when capital can flow to its highest and best use. When we all of a sudden have the sever of that relationship of capital being able to flow to its highest best use, subprime is a great example. To date, we've had over $400 billion of capital destroyed. So clearly that capital market model is not working. So what that does then, it creates uncertainty, and uncertainty is lack of confidence. So that's what we've had. So we've had various examples of events, and we've had actually responses from Washington and regulators telling us exactly how they're going to fix the problem. But what we realize is that after each event, and when they don't get fixed and it gets worse and worse and worse, at what point are you going to lose confidence in the ability to fix the problem? And that's really where we are today. So the lack of confidence is it's critical in any capital market to have confidence in who you do business with. Mm-hmm. Confidence is the underpinning of any bank. Without confidence, you lose your reputation. As we learned with Lehman Brothers very quickly, Wachovia, and basically Washington Mutual, it was a run on the bank. And instead of having now a run on the bank, we're having a run on our country and the confidence in our country to solve the problem.
I think also to go along with that, just in the last 2 weeks, well, we started with Fannie Mae and Freddie, and then we had Lehman Brothers, and then we had AIG, and I think, as Mark mentioned, confidence. At that point, kind of what was the breaking point was we saw some just huge financial institutions fail or be purchased. And the lack of confidence meant that the debt market, the commercial paper market in particular for these banks, stopped and dried up. People didn't want to lend to them anymore. And then what just happened in the last 10 days or so is that the banks stopped lending to each other. So in the last week and a half, we've basically had just a complete credit freeze out there where the banks they're no longer lending. To go out and try and get a mortgage, get a car loan, get a small business loan right now, it's virtually impossible to do. And so that stoppage of the credit market, the freezing of the credit market we've seen in the last 10 days has forced Congress and the politicians to have to step in and do something.
So I think from the remarks we can all get a sense that this is a real problem, pretty serious problem, pretty pervasive problem. We understand some of the root causes. Why do we need a political solution? why can't the market solve this problem? It seems to solve most problems. We're business school students or professors. We have some reasonable confidence and faith in the market moving to find the highest value for its funds. Why not now? Nalin?
Crack at that if you want. I kind of see two reasons to do this. At one level, there's a fear that the impact of this would permeate beyond the financial services industry into what's called the real economy, or Main Street, as people say. Because it is a question of credit being hard to come by, the credit squeeze that we hear about, it makes it so difficult for many of the activities that we do on our day-to-day life difficult. So for instance, if you're buying a car, the financing for the car is now going to be scarce. If you're buying any kind of durable good, washing machine or doing a change to your house, all of those things require some kind of financing. But most of what we do on our credit cards is getting to be more and more difficult. So the impact on the real economy could put so much pressure on businesses that are way outside the banks and the investment banks and the financial services firms we think about. And if that happens, that could drive the economy into a recession and could drive it into a very deep recession. Things could get very bad.
So Apple's the today example of that, right?
Exactly. Yeah. Exactly.
They were downgraded because of concerns that people wouldn't be able to purchase Macs or iPhones, and
since there's some amount of financing required.
Right, and I can't remember exactly how much it went down by today, but a lot.
Which as a result, this is not a bailout of Wall Street. This is a bailout of the U.S. economy, and I really believe the world economy. And I don't think that's really getting across enough.
We tried a private solution. When this all broke last year, one of the first reactions on the market was to try to set up a fund of major New York banks to buy these mortgage debt collateralized debt obligations, CDOs, and it didn't work. And so at this point, some intervention is necessary. At this point, I'm just going to have to just stay with me for a minute here, because you'll never understand any of this if you don't know what a CDO is. So I'm going to take 1 minute to explain.
Please.
Imagine you have a pool of securities. Now, this has been done with commercial loans, credit card loans, but the one in question here are subprime loans. And imagine we've put together thousands of subprime loans into this big portfolio called a pool. Now, each individual mortgage, we probably can estimate the default risk. If we knew the FICO score of the borrower, we knew their zip code, we'd have a sense of property values, we probably could understand that. To understand the risk of this pool, though, we're going to have to understand the correlation of the risks, and that's where we get into trouble. We thought we understood that. Well, now, imagine that we've taken this pool of mortgages, put them into a trust, and then the trust is issued a liability. That'll be called CDOs. And what it's going to do is to order the liabilities into what we'll call tranches. Now, the idea is that one class, the equity class, will suffer the first 10% of default loss on all the investments. So that's going to be a very high return, high risk investment. But there's probably hedge funds who like that sort of thing. If there are less than 10% default, then they're going to be fine. Below them will be another class, a mezzanine class, who will get, say, from 10 to 20% default. Below them, there'll be another class that'll get, say, 20 to 30%. And below them, you'd think there's a very safe class. So you'd have to have more than 30% default before the very safe class would suffer any loss. Well, those are the ones that the Moody's and Standard & Poor's would assign a AAA rating, because we have no historical experience of defaults being nearly that much. This typical default loss might be maybe 8 to 10%. What we missed, and what Moody's missed, and S&P missed, was a common cofactor across all the mortgages. You see, the key is always going to be correlation. You have to understand the correlation of the assets. Now, we thought that they were geographically dispersed and each individual event would be an own crisis in an individual household. They missed the fact that declining housing prices in general would cause default probabilities to increase across the board. So the very safe classes who thought they were very safely rated at AAA suffered a problem, because now when we started to see a higher and higher default experience, the rating agencies could no longer call them AAA, so they had to be downgraded to single A or even lower. And investors like AIG, who thought they had very safe investments, found they were no longer so safe. So the big problem here is that we now have a large collection of assets in the economy that have been created that are extremely difficult to value, because we simply don't know what the correlations will be and the future default probabilities. We just don't know that. So what do we do with them? Well, now, for accountants under FAS 157, if you haven't learned FAS 157, ask that question in class tomorrow. You want to learn about FAS 157. FAS 157 is the fair value accounting rules that are, I think, unfairly getting a lot of blame for the current crisis. This is where we have to report assets at fair value, but indicate how the value is obtained. So there's three different buckets. One class is where you have an actual market price to get the value. Another one where you're using market observations. And then the third, the scary one, is class 3, which is based on a model. So now we're using models and assumptions about volatilities and correlations to come up with a value, but we don't know how to get that value. But the firms are required to report that. And therefore, market values fall. And the big concern now, because we know some banks are heavily exposed to the mortgage market. We just don't know. So don't be surprised. This week you will probably see, I'm guessing, National City and a chance that Fifth Third Bank out of Chicago will be the next in line, because they're heavily mortgage-oriented banks, but we just don't know what they're worth. And the private sector can't handle this.
Yeah, just one final point to what Don had mentioned. Really, the issue Don's describing here is model risk and the uncertainty. Now, what's very interesting about this, a lot of banks potentially entered into these sort of risks without truly understanding the level of risk, whether they just weren't modeled correctly, very bright people but just had the wrong model, or again, the fact that they ignored the results of the model. But the point is, if you're buying a house in a floodplain, right, and you're told that there won't be a flood for 100 years, in the back of your mind, do you ever think about maybe the flood could happen? So the point is that on Wall Street, when you have very sophisticated shops, sophisticated banks taking sophisticated securitized mortgage bets, then you would expect that they would actually use at least common judgment, stress testing, historical analysis, and say, hey, what if? We adjust these assumptions, and what if correlations don't hold up? What does this mean in our models? How big could these risks truly be? And I'll just get back to my earlier point. When these banks, and there are numerous banks, in 2004, 5, and 6, and 7, when they were collecting billions of dollars in revenue, clearly that was a time to realize that you don't collect buckets and piles and wheelbarrows of money without taking the equivalent risk. And clearly, these banks did not find a money machine. Clearly, they took greater risks to get greater return. So in summary, we can't just go back and say, well, the models made a mistake, it's the model's fault. Because clearly what we do know is that models themselves are part of it. But the capital markets are made up of human behavior. And until we can model human behavior, then we're going to have to use human judgment in the management process. And I think that was one of the biggest weaknesses that we saw that is going to come out as a result of this banking debacle.
All right, so we are at the point where a political solution looks like it's going to be the only way out of this forest if it was the case. And so perhaps we could talk about the plan that Secretary Paulson and Chairman Bernanke had put forward, and that was then amended by the congressional leaders and was defeated today. Was it a good plan, a bad plan? Sort of good plan?
Yeah, it was kind of mixed. Kind of mixed.
Well, I guess without being glib, what were the components of it that you thought were useful and constructive, and what do you think were those components that ultimately caused its defeat, and was that a sound political judgment given the economic facts that we're facing?
So the way I thought about the plan is that there are sort of 5 facets that I wanted to look at in judging the plan. First of all, would it be effective? Would it in fact work the way it's intended to work? The second is what's the cost of this? In this case, cost to the taxpayers. Hidden in this, and maybe this is the third point, is is this fair? Are the people who are bearing the cost in fact the ones who are reaping the benefits of it, or is it really a subsidy across different classes of people? The third is who is executing this plan, and is there accountability of the parties who are trusted with executing the plan? And finally, is this a politically viable plan? Because you could embark on something, and if it's not politically viable, it may not fall through.
So what's the answers then?
So it's a balanced story. And from what we can see, the way I understand the plan, not all of the details are fully specified ahead of time. So from my vantage point of view, the cost, the fairness, and the effectiveness would all depend on which assets are bought, which institutions are included in this, and at what price are we buying these. Yeah. So for instance, we were hearing that my summary of what we talked about, the causes of it, is that institutions were holding these assets that were much lower in value than what they were originally reported. The plan calls for purchasing these assets at a higher price, presumably at a higher price. Well, what price? Because what's really happened here is there are various estimates going on here. One of the estimates is that something that's worth $1 trillion now seems to have a market value of close to $100 million. So 90% of the value could have fallen on some of these things. And to make matters worse, these are not even traded now because trading has pretty much stopped in some of these things. So is the government talking about buying these things at a fire sale price of close to 100 million or even below that? Or are they talking about buying them close to what their face value is? And there's a wide range of potential values that could be included in here. Now, if what we are talking about is by going through this process, we actually save the potential contagion effects into the rest of our economy, and it enforces the trust and credibility that's required to ensure that the process goes through, maybe the net benefits to society and the rest of the economy is worth it. Mm-hmm. Then comes the issue about then, if it works, who gets the benefits? So one of the interesting plans of this was that, interesting features of this plan, was that in return for using taxpayers' money in the plan, the taxpayers would get some equity or some upside participation in these institutions. In this case, through a preferred stock, convertible preferred stock issue. Now, none of those things are fully specified. My feeling is that one of the difficulties that people in Congress are having dealing with this is because not all of the details are fully specified. Maybe it's inherent in that we cannot fully specify this at this point. So I have the same difficulty in figuring out where exactly to come down.
The plan, if you haven't had a chance, I read it today, I suspect some others, it was 107 pages. And what it called on was the secretary to figure out how to value it, right?
And he has to announce it 2 days before he actually starts buying, and then he has to stop 45 days after that. So it's this.
Others.
I think we have to do something, and there's one aspect of this whole problem we haven't really addressed is how this is a global crisis. Let's just start with Fannie Mae and Freddie Mac. Why were they essentially nationalized? For years they had existed as sort of like an agency with a quasi-government role. Many people in the market believed that their debt had the full faith and credit of the U.S. Treasury. As it turned out, they did. So for many years, they were earning a little bit higher yield for willing to take that risk, which turned out to not exist. Why do we do this? Because so many foreign investors owned Freddie and Fannie. Bank of China owns close to $1 trillion in between Treasury and agency debt. We simply had to guarantee that debt. we had to bring Freddie and Fannie into Treasury and make them equivalent to Treasuries. In the same way that many foreign investors bought what they thought were AAA-rated U.S. mortgage-backed securities. Now, because of the complexity that we've been talking about, there is no way to independently verify the credit risk. We can do this on a corporate bond. You can look at the pricing of the bond, and you can back out a default probability on an individual bond, and you can decide if you agree with Moody's or not. You cannot, absolutely cannot do this on these mortgage-backed securities. You don't even have the data, even if you are so inclined. So there was complete and total trust on the credit rating. So in a way, we're kind of stuck. We need foreign investors. We're more dependent on foreign money than we are on foreign oil. Think about that for a little while, all right? So we have to do something to shore up confidence in the U.S. markets, and a lot of what was done today simply just makes it more difficult. We needed to show the sort of a united front that the government is doing something to support our markets, and we'll see what happens tomorrow.
You know,
Marcia?
as was mentioned earlier, that one of the problems, it seems to me that it's generally has good intentions and has the capabilities of being a very good plan. But as was mentioned before, some of the problems with the plan were basically the U.S. government would run an auction and they would buy back these securities from the financial institutions. And if the brightest minds on Wall Street are incapable of valuing these securities, how are regulators going to be able to do it? You know, you've got the wide variation. $1 trillion portfolio might be selling for $100 million. Well, built into the plan is equity ownership. Great. Let's let the U.S. government buy these for $100 million. Eventually, there'll be liquidity back in the market. We sell them, and the U.S. taxpayers get their money back. So I thought that was an excellent part of the plan. Things like executive compensation. The reason we have these things like the golden parachutes is to give chief executives of firms the opportunity to take risks without worrying about all the negative consequences. When you take risks, you make more return. But the problem is these CEOs took risk, and now it's the federal government bailing them out, not the stockholders losing the money. So we're getting rid of the golden parachute types of payments to CEOs, which I think is a good thing. And then one of the other big things in the bill was oversight. And I think we've got a lot to do in the upcoming years in terms of regulating these institutions, but at least in terms of how the $750 billion was going to be given out, it was going to be done. But the decisions would be made by more than one person, by a group of people. So that was a good. There were many good things in the plan. You know, so overall, I think it has a good basis.
Yeah, let me just quickly answer Dean Lawson's question, because it was a great question. That is, you know, does the plan work? Does it make sense? Is it a good plan or is it a bad plan? And I think in particular, I think we all can agree it's a good plan in the sense if it accomplishes its goal. And that was to provide liquidity to the market, get sludge assets off the books of these various banks, inject it with fresh cash so banks would then lend to each other. Then banks would behave like banks and lend to you and I. So clearly that's a good idea. Now, the challenge, though, is, and I think where the breakdown was really the ability of Ben Bernanke in particular, and then Hank Paulson to be able to explain this story and actually sell it to Congress. And I think that's the big disconnect that we've had. And unfortunately, it's sad because I think in generally the essence of the plan is very solid. But I think the three questions, the basic questions that Congress had asked from the very beginning of this bailout were never truly answered. Number one, how come $700 billion? You know, why not 3? Why not 5? Why not $1 trillion? Clearly, they didn't answer why. The second question, what is the oversight? Who's going to cut the checks? Who's going to be involved in the mix to make sure that this money is spent in a diligent fashion? And then lastly is how strong are we going to have controls over executive comp so us taxpayers, as we're paying out this billions of dollars, to make sure that executives are not going to benefit from the compensation scheme. So clearly, answer to question 3, I think Congress got the best answer. Number 1 and number 2 was never fully answered. The vote, the fact that it failed by approximately 10 votes today, proves the fact that there was such a disconnect between, you know, communicating to Wall Street a very solid plan. And I think that's the unfortunate story here. Clearly, you had some very bright people that did not effectively communicate to Main Street how significant and how severe what we're entering into is for our financial system.
Can I ask a little follow-up question? I've heard all of you talk, I think all of you talk about how very difficult it is to value these instruments. So how could we expect Paulson to know how much money it would actually take to get this job done?
I think that's a fair question. I don't think we can expect him to know precisely the value, but I think he can speak about the volatility in the, for example, how much more will the market move? I've seen estimates that the real estate market, the bottom will be 30% from the high. Mm-hmm. I've heard estimates of 35%. I mean, could it be 40%? What would this mean? I think having a scenario analysis saying, we'll need in a range of 500 to $1 trillion. Does that convey the message? It may be too broad of a band. But clearly there is a value that can be placed, and the responsibility to some extent needs to be at the Treasury level, but there also has to be accountability and the oversight of when that check gets cashed by who and how much.
Okay, well, I have one final question, and then we're going to take questions from you folks. So if you do have a question you want to ask to the faculty, why don't you start quietly making your way to a microphone, and I'll ask my final question. So, okay, I get it. Where do we go from here?
I wish somebody would tell me.
It's always better to be a questioner than an answer.
No, well, a couple of things are obvious. Obviously, the regulatory system has to change. And that will take maybe a couple of years of congressional work, but that's the big number one.
I think immediately we will see a new bill come up in the House. I would bet before the end of the week.
Mm-hmm. Any speculation on what'll be in that wasn't, or what will be out that was?
I haven't heard enough yet about why exactly the no votes occurred today.
Yeah, I'm afraid there might be political reasons that is making this so difficult to get this bill across, with the presidential election as well as congressional elections impending. Mm. So it's not just economics and logic here. There might be something more than that going on here, which might make it difficult.
Yeah, and I would say finally, when you have a patient that's getting rushed to the hospital, the first thing that gets done is to stabilize the patient. So I think in the short run, clearly the focus is on stabilization of the economy. The long run will be increasing the regulatory oversight of the Fed. But in the short run, there's got to be confidence developed very quickly. And I see central banks around the world getting together, powwowing, and sending a uniform message to the capital markets. And I think that's what it's going to take. Unfortunately, the Fed and the SEC, in particular the Treasury Department, has not been able to get the weight they needed to convey that message and calm down the capital markets. And at this point, the capital markets are teaching the U.S. economy a lesson.
Well, thank you all very much. I appreciate your insights. And let's start over here at, I think you were up first. If you could tell us your name and ask your question. Doesn't sound like
I can just speak up.
Sure.
Speak up.
It's louder.
My question pertains to obviously what I believe to be the most important fact of this matter, and this is the effect of mainstream economy. And I believe when I had the chance to actually look at the bill, I think it was Section 8. I'm not sure if it was changed since I had seen it, but it dealt with the fact of how the actual folks who were victims, so to speak, of these subprime mortgages, in which I believe to be true, that they actually were victim of somewhat teaser rates when they knew that they would actually balloon into bigger rates. But my question pertains to the fact of how these folks who have these mortgages, that many of them have been forced to declare bankruptcy, how they are going to be compensated, and if it's going to be their responsibility to declare bankruptcy and deal with it themselves, or if there is going to be some sort of a federal intervention to help the actual people in this sector out.
Can you hear? Essentially, how are the people who have these subprime mortgages who were in default, are they going to be taken care of by this bill?
I thought that was really unclear in the bill. They didn't go so far as to allow bankruptcy judges to restructure the contracts, but they made an emphasis on minimizing foreclosure. That was very unclear. We have to be clear about one thing. We do need to keep people in their houses, because what destroys communities are boarded up, empty houses that are in the process of foreclosure. So we do need a system that keeps them in their house at an affordable monthly payment. And it gets very hard when the owners of the underlying mortgages are so far removed, literally far removed, either geographically or through legal structures, from being able to negotiate with that homeowner. That is something that I didn't think the bill did a good job of addressing that.
It didn't. There was very limited wording in the bill about helping defaulted homeowners. There's wording in the bill where the federal government would support renovation of homes that have been defaulted. But that's about all that I know was in there.
Yeah, one of the key items, which was the start, was that Congress in particular wanted to make sure there was some sort of support for those people so they wouldn't be cast out of their homes. And that part of the bill was stripped out at the last moment.
Yeah, that's actually why I asked, but I appreciate the insight.
Thank you. I think you were up next, and then we'll go over here. So, your question.
I'm Charles Van Dyke. What sort of ramifications do you think there should be for the credit rating firms, who basically sort of were one of the major causes of the issue, and then also exacerbated the crisis by adjusting credit ratings at supremely inopportune times?
Well, there's almost a value judgment there, but the two parties who seem to be not entering directly into the discussions but clearly had a role to play in this were the rating agencies and brokers. Since they were both, their compensation and their fees depended very much on being able to do these mortgages. It's not necessarily based on their viability. One of the things that I've heard being talked about is to have the rating agencies really were equity holders in this thing and should not have been in a fee-based structure. In other words, they should really be participating in both the upside and the downside of these mortgages. Now, that really is not their role, but that's kind of the role they ended up playing. And it's kind of like the analogy that I have is in insurance, the underwriter of the insurance does the assessment of the fact that a policy could go bad, but the salesperson of the insurance policy gets compensated for selling more policies, independent of whether the policy is a good policy or a bad policy. Now here the rating agency kind of sat in the middle and became like the assessor, and said, well, this is a good policy, but there are no ramifications for being wrong. And that is...
I think most importantly, the rating agencies, what they do when they provide a rating, they base it on the best of their, the information they have and their stated opinion. They're not stating facts. So their response is, well, we try to do it the best we can. We can't always get it correct. Now, I think, we've got to reassess that. We saw rating agencies, they missed it in regard to Enron. 2001, by October, Enron was still rated BBB+, but clearly, December 2nd, they were in bankruptcy. We look at Lehman Brothers. Lehman Brothers, as of last Friday, or before the bankruptcy, they were actually rated in the A range by Fitch. And Monday morning, even after the Sunday night bankruptcy, that's when Fitch came in and downgraded them to D. So clearly, in these examples, we need more accountability from the rating agencies to do a better job. But rating agencies, in part, to subprime, to actually go to their defense, they were provided data that was given by security broker-dealers in doing these transactions. Historical data, very little was available. So in essence, some could argue, again, all of this is going to be put in congressional hearings, trust me. They only could make decisions based on the data they had. Junk data, junk decisions. So I think we've got to wait and see exactly how bad the rating agencies missed it.
Was one point on that. We learned after Enron that the auditing firms have to separate their auditing business from their advising business. There was a conflict of interest there. Same thing with the rating agencies. They not only would rate the securities, but they would offer advice on how to structure the securities to attain a particular rating. And clearly we need separation there. Another aspect, it's actually bizarre if you think about it, that the rating agency, the ratings are paid for by the issuer. You'd think the one who desires the information the most is the investor side, so maybe another way of restructuring this industry would have investor purchased ratings as opposed to issuer purchased ratings.
Thank you.
And my question is regarding kind of looking at it the other way around. What do you think about Barclays and Deutsche Bank? I mean, these are banks with trillions in assets that you said were heavily invested, I mean, in these securities that are going bad. If those banks fail, I mean, our government doesn't really have too much power to help them out. But what do you think the main effects of that would be on our economy? And what's the probability of that actually happening?
You did see the first international failure, big one today in Fortis. And the central government in Europe will step in and do the same thing that our Federal Reserve is doing.
And there was a second one in the UK, wasn't there?
Yeah, smaller one. Smaller mortgage bank.
Yeah, I think where these big international banks have going for them is their economies are not at the same spot that our economy is. They have diversified deposit bases, diversified loan portfolios. They did not get into subprime to the level that we did. So we would think that that would reduce the probability of their bankruptcy, but that does not eliminate or rule out that that'll happen.
Thank you very much.
Hi, my name is Leo, and, well, it's loud. I'm a sophomore in undergrad SMG, and my question also has to do with international banks that were stakeholders in these debt obligations that were rated very high by American rating agencies. My question has to do with the long run. How do you think this crisis will affect the views that private investors from foreign countries view our financial system? Will they lose a lot of confidence because they were told that these were good debt and there wasn't going to be a lot of default, and it turned out that they lost a lot of money. And in the draft of the bill that was not passed today, I don't believe they mentioned anything about what they were going to do, how much money they were going to spend in compensating these foreign banks. So
I think you're right. There wasn't anything in the bill that I recall about.
In answer to both these questions, I mean, I think there are two types of responses that one needs to think about. One is the short-term bailout, which is trying to calm the fears and trying to bring some sense of stability into the markets, which might prevent this sort of contagion effect that's happening. But most of what you're talking about, I put in the category of the long-term structural changes that need to happen, such as what needs to happen to the way rating agencies function and so on. My only response is something that finance theory has for a long time been talking about for these markets to function well, which is to provide better transparency through the system. And that becomes increasingly more important as the original owners of the asset are so far removed from the final securities. And one of the difficulties that we had is we had to rely on this sort of distant data, historical, statistical data and so on, rather than the actual information on the asset. And we now don't have a mechanism to get transparency into that. So the structural changes when people talk about is how can we bring about better ways to report this stuff that would therefore make the life of the rating agencies better so that we can actually prevent this. I know it's not a direct answer to the question, but I think of that as a structural change that needs to happen in the long run, and the short run is there. It's a different.
Just to add to that, investors aren't going to be compensated directly, but what we will have the opportunity to do is to increase the confidence in the system, and investors' investments, foreign banks' investments in the banks here will go and increase again. But there was definitely nothing in the bill about any kind of stockholders.
Thank you. Yes, ma'am.
Hi, my name is Ann Clevey, and I would like to ask the panel about the regulatory framework in this country, specifically how the regulatory framework needs to change to prevent a future crisis such as this, and also how feasible do you believe such a change would be considering budget constraints and the political situation in the country at this time?
About it.
Well, I think clearly the regulatory regime has to change, and what that means is there has to be better consistency on what is evaluated. In particular, regulatory bodies. Let's say we started a bank here in Boston, we could have actually a state banking regulator looking at us, the State Banking Commission. We could have the FDIC evaluating us. We'd have potentially, we even could have the Office of Comptroller and Currency and the Federal Reserve, depending on sort of exactly our responsibilities. The point being is there's overlaps. And what happens is the regulatory regime to date has not really focused on what we call risk-adjusted or risk-focused examinations. Clearly, there should have been priorities set. I used the example earlier with the SEC. If they have a mandate to review over 146 broker-dealers and they only create 6 reports fully completed, that is not taking on the responsibility of that regulatory regime. So clearly there's going to be a consolidation in the industry. What this means basically is the Fed's on top, the SEC will lose out. I think there'll be greater consolidations. But most importantly, there's got to be the tools and sophistication in place to be able to evaluate these risks. Think of it this way. If you can't measure the risk by a sophisticated model, or sophisticated techniques, or sophisticated people, then do you have a business to actually be taking that sort of risk? And I think that's the big lesson here. Clearly, the risks weren't truly understood, or they were just ignored. But the regulatory regime, too, failed to give us red flags, failed to identify it early enough. The red flags should have been identified. So I think there's going to be a large postmortem, but the consolidation in the industry, in the regulatory industry, is happening already. It's happening behind the scenes right now.
I also believe you're going to see changes in the way these institutions are actually regulated. It was mentioned earlier that a lot of these mortgage-backed securities were off of the balance sheet of these financial institutions. And they are regulated at the bank level, but certainly they weren't at the investment bank level, and we're going to see a lot more of oversight over those types of instruments.
I think this is a very hard problem because, well, if you think about regulation, you have to learn about Basel I and Basel II if you've had those courses. Back in the 1980s, we realized we needed more international bank regulation because banks do compete. They no longer are in their own market, but they compete with each other. So we wanted to homogenize some of the international bank regulations, and they focused at that time really only on credit risk and used a very simplistic way of identifying how much capital a bank would have to hold against its risk assets, a very simple weighting system. If you held government securities, they were considered to be perfectly safe regardless of maturity. If you held mortgage securities, they were only 20% weight because they were viewed to be pretty safe, whereas corporate loans were 100% weight. Then with Basel II, this is the current rules that are soon to be implemented, we realized we need to look at other types of risk as well, operational risk, liquidity risk. And we thought at one point that banks know their risk better than the regulators. So there were actual proposals that said that banks should report their level of risk because there's no way a regulator could ever know their risk better than the internal bank. Well, look at the last year and you realize that we really don't want to go to bank self-reported risk.
Right. Thank you very much for your question. Sir?
My name is Benjamin. Ever since the collapse of Bear Stearns in March, it seems that the Fed has done a lot to try to inject liquidity into the markets, whether it be term auction facility. Also, I just read this morning that they spent $600 billion last night to try to inject liquidity into the global capital markets. It seems that nothing is working to unfreeze the credit markets. Let's say that the bill passes, we spend $700 billion to get the bad assets off the banks of the books. It's pretty clear that our economy is probably going into a recession. There might be a global recession. Housing prices are declining the most we've ever seen, maybe in the history of the United States. What's to say that if I'm a bank, once I get the assets off my book, how are you going to force me to lend? I mean, it seems that we've been trying to force banks to lend. It just hasn't been enough. But I still think, $700 billion, they'll probably just take the cash, hoard it on their books, buy some more treasuries, and we'll be in the same place we are today.
We got it.
Well, that's the problem Japan had in the 1990s, the classic problem. You can increase liquidity in banking, but bankers will not make new loans unless they're good loans to be made, and they have to see a strengthening economy.
When Bear Stearns failed, the federal government stepped in and said, we're going to take care of this problem. I forget what was the name of that big bank that failed between Bears and Fannie Mae. The Fed, whatever it was, the federal government said,
IndyMac, right.
They came in, the Fed came in and said, this bank's failed, we're going to take care of it. Well, we've now gotten to a point where we've had a series of failures, and the federal government has said, we can't now do this one by one because we are now also losing confidence in the whole system. So the $700 billion, and I do agree with Mark, it's probably going to end up being more than that, is taking a different kind of step in that now the federal government here, and I believe this will broaden out to central banks across the world, are going to inject funds into the system. And more importantly, they're going to take those funds and they're going to be actually buying the bad assets off of the balance sheets. So what you should see as a result of that is fewer failures, which will increase the confidence again. So they're taking the proactive step to actually get the take care of the balance sheets, get the bad things off there where they weren't before. They would let it fail before they would do anything.
Thank you.
My name's Alex. I just had a quick question more regarding the human capital. I know we've touched a lot upon the fundamentals and definitely the bailout plan and thoughts on that, but I could guess that more than some of the people here are here today because they're either seniors or they're graduating, they might be worried about the job market. But even to structure the question a little bit away from the college students who are still young and we're all still learning and we could all still go to graduate school if we want, what about the human capital of the people that are in these institutions that are being bought out? I mean, the Lehmans, the Bear Stearns, Wachovia. I mean, we're talking about thousands of extremely intelligent, extremely established individuals who essentially could be turned out on the street because, I mean, how many people do you need to do the same job? So I was wondering if you guys had any insight as to where that might be going in the future or trends you saw. We could touch on that.
I think short run, there's a dislocation. There's clearly very experienced investment banks floating around Wall Street now looking for jobs. I'm not going to say that you're going to pick up a cab at Penn Station and see a former Lehman investment banker actually driving you, down Broadway. But I think your point is, the question is very apropos, and that is, so how do we take this intellectual capital? Lehman Brothers is a great example. They had one of the premier utility investment banking firms, meaning that if you were a utility across the country, you would call them first. If you were doing a mergers or acquisition, if you wanted to actually do, let's say, raise additional capital or get involved in an IPO of some sort for a private company. Lehman now is no longer in that business. Barclay has not told the community yet, that is the utility community, whether they're going to keep the investment banking firm, that division. So it's going to be sorted out in the next few months. But we could be losing some very valuable intellectual, as you call it, human capital. And as a result, that could negatively impact the growth of an industry like utilities, which no longer have those experienced investment bankers that have the long ties with the industry and understand how debt is issued in the marketplace. So that is of concern, and it's discussions that are happening around the United States as we speak.
And of course, you're talking about the financial sector, but it's happening in the auto industry, and so it's an economy-wide problem. Yes, sir. Thank you.
Hi, I'm Matt from Cohort C. Thank you for taking my question. Glad we're well represented. I'm also glad that you had mentioned Japan. I'd lived in Japan for a couple of years and later worked for a Japanese company. I was wondering are there any lessons to be learned about how Japan handled their banking crisis? It seemed to be some vague similarities in terms of what the government felt they had to do, but you're alluding to the fact that maybe they weren't so successful, at least at first.
There have been a number of crises around the world, and there's a lot to learn, as others will be learning from our crisis in the future. I think one thing we learned from Japan is to deal with it quickly. I think they really tried for a while to just hope it would go away and hope the banks could earn their way out of the problems. We're addressing it sooner. There is one recommendation that I'd make that drawing on the European model, which is what's called covered bonds. You'll hear more about this in the future. But the idea of a covered bond is where the originating bank, again, traditional commercial bank relying largely on deposits, would issue long-term debt that is backed not only by the mortgages, which it would continue to hold on its balance sheet, as well as the general balance sheet of the entire bank. But this is widely done in Europe. It's not a panacea. Spain's been having some trouble, and a lot of their banks have covered loans as well. But it's one way where we can get around the disconnection that we've seen between mortgage brokers originating the loan and then selling them on to the packager and not having really a say or having ownership, if you will, of the underlying mortgage. So there's a few crises that I think we can look at. Again, I think covered loans is going to be one of the solutions.
I think the first point that Don made, which is that the need for acting before it begins to impact the real side of the economy, is often been cited as the lesson to learn from the Japanese experience. Because what happened, it lasted for 6 to 8 years before the economy came out of it, because it was by the time that the financial crisis was attended to, it had already hit the real side of the economy, and adjustments take a lot longer there to rebuild capital and to reskill people and so on.
And I think the most ironic thing right now is the fact that banks like Nomura are actually capitalized to the extent that they could actually go in and actually help, well, in this case, Goldman Sachs or Morgan Stanley, which went for Mitsubishi Bank. So clearly the Japanese structure now works, but it was a painful process between that 6 and 8 year period.
Thank you. Hi, my name is Mike. A lot has been talked about in the newspapers about how bad it will be if this bill does not happen, or some version going forward. But what I haven't heard about is, if the bill does succeed, are we setting a dangerous precedent for businesses in the future? I know obviously they'll be subject to larger restrictions, as you've mentioned, but are we setting a precedent for managers of businesses, large businesses, monopolies, so to speak, from factoring government bailouts into their managerial decisions? If I'm Bill Gates sitting at home today, am I thinking, wow, if I make some incredibly risky decision and Microsoft is about to go under, the government's going to maybe bail me out because everyone needs my services to survive their day-to-day activities?
Okay.
The term is moral hazard. We thought actually by letting Lehman fail that maybe we're making a step back, and finally we could start letting failed businesses fail, but then immediately right after Lehman we stepped right back in with bailout packages. I think that's a very serious concern going forward, that we've allowed these mistakes to be made and somehow everyone's looking to government for solutions.
You know, one of the results of the savings and loan crisis of the 1980s is that regulation was ramped up significantly. And I think, and that did solve that problem. We now have a different problem, and I believe one of the results will be that regulation in this area is going to be ramped up significantly to try and prevent that. It was after the 1980s and the S&L debacle that regulators increased capital levels on mortgages and actually stopped several banks from even buying things like junk bonds, or savings and loans from buying things like junk bonds. So I think the results of it will be a lot more regulations.
Thank you. Hi, my name's James. I think our panel here will agree that at the root of this financial crisis is a declining housing market. Home values continue to decline, and so a lot of people who bought expensive homes a couple years ago now can't afford them, so they're being foreclosed upon. Thankfully, most of them now are what belong to the subprime. And as much as the Paulson plan was intended to stabilize the market, it doesn't really address the root of the problem of stabilizing home prices. So it could be that for a couple of months, investors and on Wall Street and worldwide think that, okay, the market's stable. But then if home prices continue to decline in the ensuing months, it is possible that people who have taken out mortgages who were previously categorized as prime or even all day will then go into a default and suffer from foreclosure, thus continuing the problem. So I want to get your opinion on what you think needs to be done to stabilize home prices, and once that's done, would the housing prices then resume its upward trend? If not, what's the forecast that you see that a return in the housing market will happen?
Thank you.
Well, I'm going to disagree. I don't think necessarily we need to try to stabilize housing prices if they're still above, if we've had a bubble, in other words. You know, housing prices rose in the early 2000s at about, what, a 10% rate? Well above income levels. I mean, just think about it. We had low nominal interest rates. There's a level of expected inflation into that nominal interest rates. It's hard to imagine that housing prices can rise at a much higher rate and be sustainable at that. So the market's come back, what are people saying, maybe 10, 15, 20% from the highs of 2006. Hopefully it'll stabilize there, but I don't see any role for government to step in and try to stabilize housing values.
I think the challenge and why the stabilization plan was so important to pass is we need to create a bottom. So in essence, if these banks have all this sludge on their books, at what price can they sell it? We've already seen various investment banks having to dump their mortgage securities on the marketplace. And as we know, when there's a falling knife, how many people want to touch it? So we've seen prices that actually may not reflect the true market value. So markets need to stabilize. The stabilization plan needs to be put in place to just help those banks so we can get a mark to market. I mean, that's the big question. Before this, Nalin and I were talking about this. What is the true mark to market? Well, it's going to be determined by the market. It's not going to be determined by, academicians on blackboards or even by quantitative types on Wall Street with their models. It's going to be created by buyers and sellers. And unfortunately, there's been a lot of sellers in this market, and I'm looking around. I don't see too many buyers. So that's where the governmental plan was going to come in and stabilize. Try to get the buyers in so all of a sudden we have a mark to market.
Thank you.
Hi, I'm Abhiram. I just was reading about the Citigroup taking over Wachovia, and I just want to know what the strategy behind it could be. Given that the size of the Citigroup, the losses they've been posting, and it itself could be divided into multiple entities in the future, what could be the possible strategy?
Last week we were talking about Wachovia merging with Morgan Stanley, and at the time I remember thinking what a horrible cultural misfit that would be. And now Citi and Wachovia. I think that there are a few banks that want to be the survivors, and the survivors are the ones working with government to bail out their fallen colleagues. So it's very clear Morgan will survive, Citi will survive, Bank of America will survive, and we're all waiting for Wells to step up and buy someone. My guess it'll be Nat City or Fifth Third.
Citigroup's only buying the banking assets of Wachovia, and they're not even required to buy all of them. So Citigroup's actually getting a very, very good deal out of this. They're buying, I think it's like at 10 cents on the dollar.
Yeah, I think there's a lot of cherry picking going on here, buying the selective part of the assets.
Yeah, and then Citigroup also has a backstop, so they'll take the first 13% market drop in the underlying real estate, but guess who picks up the rest? Federal government. So it's actually a pretty good risk return. Well, we're sitting here now saying it potentially is pretty good, but
wait till tomorrow.
Yeah, but Citigroup has actually created itself, endeared itself, and now it's considered to be too big to fail. So I think there's some strength in being a strategy into creating an entity like that.
Hi, my name is Rohit Sharma. My question is about the investment banks, or what remains of them. And a lot's been said about their collapse or just the conversion of banks like Goldman and Morgan. So my question is, what's the investment banking sector actually going to look like? Is it simply a change in size, or is it also a change in scope and a lot of their banking functions and activities? And how does that play into, obviously, us going into that sort of field?
Yeah. I think we're going to see a return to more boutique investment banking, because the need for the investment banking function doesn't go away. I don't think it's going to be done as it's been done in the last few years, though. I think I'd be looking to talk to the smaller boutique investment bankers. The groups that'll be spun off of the collapse of, say, a Lehman will be a number of new entities from those players stepping in, but without the big balance sheet, because you can get started without a lot of capital if you're going to be in the consulting and the advisory service. So I think we're going to see a lot of smaller players.
Yeah, I think a lot of the innovation would still occur in these smaller investment banks.
Thank you.
Hi, I'm Tim. I'm a senior, and I'm worried about applying for jobs as well as I'm sure everyone else. Part of going off on one of your answers from your last question was about capital being available, and I feel like there has to be an industry in order for investment banks to invest in. And I feel like a lot of people can't afford to repay these mortgages on their homes because they've either lost their jobs or lost income due to things like globalization and this flattening, per se, of the earth. And so I feel like it feels like the only way that this country's made money recently has just been repackaging our debt. And now that this giant job loss on Wall Street has happened and the market is flooded with intellectual capital, what industries do you think are going to pick up that slack if the investment banks don't ever return to the size that they once were?
Well, we can all have our opinions on this. My personal favorite on this is, I think, a problem that we're all going to have to deal with that has kind of taken a backseat in the last few weeks is energy in large, sort of energy climate change kinds of areas. I think that sector would continue to play an important role in the next decade. And I think the skill sets you need to deal with that, and the investment opportunities in there aren't going away. In fact, I have anecdotal evidence to that effect, which is that as investors, especially private equity investors and even venture capital investors, as they shy away from conventional markets, they seem to be still very hungry and eager to go into some of these sectors. They know which will have a long-term future. So that's my personal take.
And I would ask you to look at where the hedge funds are going at this point and where the capital's going, the private equity folks. And clearly it's going into the energy sector. Whether Obama wins or whether McCain wins, we're looking at a major change in the country in regard to the amounts of money committed to new energy policy. In particular, Obama's throwing out $150 billion. We were talking about this earlier. In regard to energy, carbon trading is becoming a very big market. Within Europe, it's over $60 billion on an annualized basis. Carbon trading in the U.S. will probably be about $500 million within the next year, and probably be several billions and almost a couple trillion dollars if carbon takes off globally the way it's anticipated. So there's a lot of entrepreneurial opportunities in new sectors, and clearly alternative energy is one of those new sectors.
And just to add to that, especially the financial skills that were used in dealing with the fixed income securities can be pretty much directly transferred to the carbon and electricity markets, which are the new markets there.
I'll just recommend Tom Friedman's new book.
All right, thank you.
Hi, I'm Subrat, and my question was regarding, again, the regulatory framework. But I was thinking on other terms. So in the long term, if you have too much regulation, do you think that there is risk of hampering the economic activity and in turn reducing the prosperity of the nation?
Not when you assume that the point of regulation is to safeguard the financial environment. So I don't think that the added regulation, and we've had a huge breakdown in that, and so I think the added regulation is going to be intended to shore up where we've had holes before.
Yeah, when we say added regulation, we mean smarter regulation, risk-focused examinations, and we haven't gotten to that point yet.
It also, Mark, you stressed this, which is it's not necessarily new laws, but the enforcement of the existing laws. A lot of what you talked about was that.
Yeah. Thank you. And our last question.
Hope it's a good one.
He's got
I think it was in 2004 the SEC changed the rules on the investment banks, brilliant people at the SEC, allowing them to take what was supposed to be, I think, 12 times leverage on their how many dollars they had, to unlimited silly amounts of leverage. How much is the crisis currently a product of just too much leverage, and if we didn't have that rule change, where would we stand today?
Well, within investment banking, that was the house of cards. And when we saw that at the demise of Lehman Brothers, at the height, Lehman Brothers equity, that is, if you look at their gross leverage, it was 30 times. So what that meant is that you could have a very small change in asset value that would wipe out all of equity. And what it came out to be, only a 5% change in market value totally wiped out their equity. And what we realized in those types of scenarios, that we have to change the leverage ratio. There's no question leverage ratios are going to be reevaluated. Now imagine the new world, because that's what we're in. Investment banks are now part of commercial banks. Commercial banks' risk profiles are much different, and their leverage ratios are no more than 8 to 10 times. So clearly, investment banks are going to be levered down, and I think in general, banks will be levered down. So regulation is going to be honing in on leverage ratios.
I'm surprised no one asked about short selling. Yeah, I don't have an answer on that. I'm kind of have really mixed feelings on it. But to answer your point directly, yes, leverage is really huge in this current problem. But short selling, if you're not familiar with it, basically this is when one borrows a stock and then sells it and then planning on buying it back at a lower price. And it's a standard investment strategy and is widely used in hedging. And the current ban on short selling for almost 800 different stocks is a major change in the equity markets. And there'll be a lot of studies about what happened. If any of you are particularly interested in that, I suggest today's Wall Street Journal on the editorial page, an editorial by Arturo Briss about short selling.
Hopefully this is the last one. Lately, a lot of people have been talking about different Chinese banks or Japanese banks or Asian banks in general trying to take over different parts of assets from the American banks. How is this going to affect the American banks and the crisis in general?
For the last 15 years, any bank operating in the U.S. has been subject to U.S. regulations, and I would expect that's going to continue, if not be strengthened.
A related question is about sovereign wealth funds in particular, which, again, we rely on for sources of additional capital. And the question is whether or not a sovereign wealth fund would then try to have some impact on management or decisions management would be making. And so far the evidence is that they haven't, but I think the threat that they might be is there.
Thank you.
Thank you all very much for coming. Please join me in thanking